So we talk a lot about equity financing, but what about debt? Because I'm sure that's something you probably see a bit more in your client base than we do in ours.
Yeah, I think debt finance is actually quite an underutilized resource.
Yeah.
And the biggest problem that you have with clients is when they're considering their use of debt finance, often it's too late. So they're up against the position where they need to get extra finance into the business, and then they go and approach banks or other third-party providers for debt. And at that point, their options are slightly limited. So we positively encourage our clients to try and think ahead in terms of what their cash flow requirements are, and that's where we can really play a part in looking at the businesses and making sure, look, what's the trading looking like for the next 12 months to the 5-year plan, and cash flowing that out. And it's often easier and more competitive to go and raise the finance. The irony is when you don't need it particularly, but to have that resource available, knowing that you might be going into a period where you might need to utilize that resource. And the reason for that is the banks and other providers will look from it from a risk perspective. And if you're planning ahead and knowing that you can forecast and understand that, they get more comfortable that you're in control of your business, knowing where it's going, rather than, oh, it's an emergency funding we need, and we've got this short-term cash flow problem coming up, we're entering into a new contract, we need to fund it and get through it, can we go and raise some finance then? They get slightly nervous how you didn't foresee that. So if you can cash flow out where your business is and see a requirement, often it's good to get that facility in place in advance of when you really need it.
I think that's right. Even we'll draw parallels with investment and equity raising. One of the most common pieces of advice is, over-raise. If you can raise more now than you think you might need, then that's valuable. That's gonna help you.
And often people say around, what type of funding do we need? What type of debt financing do we need? And that will come down to circumstances of what the requirement is. Because often overdraft facilities can be reasonably expensive with higher margins off of the base rates. But actually, if you only need it for a short term, they can often be their best options. You can get in, get the funding in and get out of it. Where if you need more longer term funding, then obviously there's other facilities, longer term loan or asset financing that you can look to raise. They often tend to go with a slightly higher margin on those. But the banks get more comfortable with that. They obviously look to try and raise their financing on the back of assets rather than just do it on a working capital lend where it's an unsecured lend, and therefore then the rates and the margins go up.
Yeah, you touched upon something that's quite interesting actually, because the whole landscape for debt in SMEs has changed quite dramatically in the last 10 years. We've got a partnership with Swoop, which they provide an advice-led service to SMEs. One of the things they help SMEs with is finding the right debt product for them. And the British Business Bank in particular have got behind a lot of alternative lenders to move away, because there's this perception that the big banks don't really help SMEs. And as a result, you get things like the BGF, Business Growth Funds, which came about. But actually, there's loads of alternative providers now who are focused on SMEs. I mean, iWalker, Funding Circle are two of the better known ones, but there's so many, and there's so many different types of loans now. Revenue-based lending, that wasn't a thing like 10, 15 years ago. Now, there's plenty of SaaS companies where you've got enterprise contracts, long-term enterprise contracts, and you can borrow against the revenue effectively. So it is something which businesses should look at more, as opposed to just turning straight away to equity-based funding.
Yeah, and as you say, believe it or not, the mainstream banks do want to lend money. They're out there, they're keen to lend money these days. I think the risk profile has certainly changed from their internal kind of policies to be cautious, certain sectors they're frightened of, to now, look, we positively encourage you to get out there and lend. So I do think talking to the banks and just let them understand why and how you're looking to raise the lend, and putting those strong financial forecasts behind you puts you in an excellent position to negotiate with the banks.
Yeah, definitely. If you're EBITDA positive and you've got good, strong cash flows, the high street banks are still pretty competitive and good offers, aren't they?
And I think that the banks are out there now, and they've got different products for different sectors. They do have cash flow lends that they're willing to look at now for the right type of businesses. So I think if you're not talking to your bank, you're not doing yourself a service. And If the banks aren't there and they can't help you, then there are other third-party providers that will look to do it. But invariably, the banks are the cheaper option for debt finance if you can go to them first and then to the secondary market to go and raise. But there's generally options out there for clients.
And it's about finding that right balance, isn't it, between debt and equity finance and also operating cash flows.
Yeah.
Tricky balance to find, and obviously for some of our tech clients, it's a bit difficult to get some debt funding into the business, but not impossible.
No, exactly. But the more established mainstream in manufacturing, retail clients like that, then the opportunities are out there. Yeah. And as I say, the banks will look generally to go and do that on an asset lend as a first basis, because that's the obviously less risky approach from their point of view. But then after that, they're quite happy to be inventive in terms of how they can do the lend, and they're willing to look to lend to you these days rather than no, we can't do that, we couldn't possibly do that. It's a lot more open door policy.
Yeah. And have you seen some of your clients taking on acquisition financing, so loans to go out and leverage acquisitions?
Yeah, more so now. And I think when the employee ownership trust structures were put in place, there was a lot of the mainstream banks that just wouldn't touch them, weren't comfortable with the concept of them. But I think that's changed now. So there's a lot more banks willing to lend. Generally, they look to do it on a 2x multiple of your EBITDA in terms of the lend they're willing to do. They will go beyond that for the right type of business and the right structure. And we've recently done one where we did a first round 3 years ago, and the business went so well. 3 years after that, just last year, we went for a secondary finance, and the bank funded the rest of the purchase because they were happy with how it was going. So they were quite interesting lends, and actually not that expensive.
Yeah.